three big planks of corporate adoption of Bitcoin are number one.
Michael Saylor, a prominent advocate for Bitcoin and the founder of MicroStrategy, discusses the transformative potential of Bitcoin as a treasury asset and its growing appeal to institutional investors. He outlines the factors driving this adoption and forecasts the potential impact on Bitcoin's price. Saylor emphasizes that Bitcoin is transitioning from a speculative asset to a legitimate treasury reserve asset for corporations. This shift is driven by the recognition of Bitcoin's unique properties as a store of value, its resistance to inflation, and its potential to outperform traditional assets. MicroStrategy's adoption of Bitcoin as its primary treasury reserve asset has served as a catalyst for other companies to explore this strategy. The company's success in preserving and growing its capital through Bitcoin has demonstrated its viability as a corporate treasury strategy. As more companies adopt Bitcoin, a powerful network effect emerges, further validating its status as a legitimate asset class. This increased adoption leads to greater liquidity, price stability, and overall market confidence. Saylor uses the metaphor of Bitcoin spreading like an organic virus to describe its natural adoption by individuals, institutions, and nations. This adoption is driven by the fundamental benefits of Bitcoin, such as its decentralized nature, censorship resistance, and limited supply. Before we delve into the video, if you want the latest crypto news, market updates, and expert insights from the top minds in the industry, be sure to hit that subscribe button and turn on notifications. Stay informed, stay ahead, and never miss an opportunity in this ever-changing world of the financial market. Thank you for subscribing to our channel.
Three big planks of corporate adoption of Bitcoin are number one, fair accounting. And we started with indefinite intangible accounting, and we get fair value accounting in January of 2025 that's mandatory. So there's been about a 4-year period of normalizing the accounting. I think the accounting is hostile and prejudicial to a well-run company. Just because if you can only lose money and you can never make money on an investment, a reasonable CEO or CFO would say, I don't know if I want to make that investment. And so even though the reality is you would make money, on an accounting basis, it would look like you're losing money. So I think that was the first challenge. The second challenge is fair treatment as an institutional asset, via the Securities and Exchange Commission or the major financial regulators. And we started to get that January of 2024 with the approval of the spot Bitcoin ETFs. And before that point, a lot of skeptics were of the opinion that maybe it would be banned, or they're not sure it's an actual real asset. You have all the skeptics saying it's tulip bulbs or it's a Ponzi scheme or something. But of course, the SEC would never approve an ETF for a Ponzi scheme. So probably for people that don't really think hard one way or the other about this, they're reflexive investors, they're looking for that endorsement from the most important financial regulator in the world, or regulators in the world. So that was plank 2. And I think plank 3 is fair treatment from the banking system. So right now, it's impossible for most major banks to custody Bitcoin, buy Bitcoin, or sell Bitcoin for you. There are a few banks in Switzerland. I mean, there's Standard Chartered Bank in Europe. There are some of the banks in Brazil that can handle the asset. But the major corporations, right, the Microsoft, the Google, the Amazon, the Apples of the world, they wire billions of dollars a month to a too big to fail bank, right? A bank with $1 trillion balance sheet. And right now they wire the billions of dollars a month to buy sovereign debt. They're just saying, okay, take this $1 billion today and buy T-bills with it. And it's like a 10-second transaction. It's routine. They've been doing with the business with the same bank for 30 years, 40 years. Citi is National City Bank. National City Bank was the bank of John D. Rockefeller, run by his brother. Okay, that tells you how far back. J.P. Morgan, right? Try to remember who founded J.P. Morgan, right? And how far back it goes. J.P. Morgan wasn't the first, right? He took it over. So what you have are these 100-year-old banks and 100-year-old relationships. And at the point that a CFO can send $1 billion of cash to their bank, buy $1 billion of Bitcoin, do it and hold it there, no risk, right? Or what they perceive as no risk, right? These are too big to fail banks. So the shareholders of Apple and the shareholders of Microsoft, they're not obsessing over the risk that Apple and Microsoft take to do business with Bank of America or JP Morgan or Citi, right? Or Wells Fargo. So that's a very important thing. When you've got all three, when you've got fair accounting, when you've got fair, securities treatment or trading treatment, and when you've got fair banking treatment, then you'll see mega corporations that will think, okay, well, this is a reasonable thing to do and it's practical to do. Until you've overcome those three, then you've got problems to solve. After you've got the three structural, look, if the accounting is prejudicial, and if the regulator is prejudiced, and if the banks are unwilling to do business with you, those three things are just showstoppers, right? We haven't even got to the question of what's my allocation, right? Mm-hmm. So I think that the allocation is zero for if you say to a corporation, you're only going to lose money on an accounting basis, you'll never make money, the allocation is zero. If you say to an institutional investor that trades on the New York Stock Exchange or trades in the US and they're regulated, and you say you can buy it via IBIT or via FBTC using with a call to Morgan Stanley or JP Morgan, then the allocation might be something. But if you say you have to set up an account on FTX or Binance or offshore, or even on Coinbase, well, I mean, the allocation is probably nothing, right? It's probably zero. So this is a 0 to 1. So I think those first three things are what's possible for the asset to come to life. After you have those things, then there's a discussion of, well, what's the volatility? What's the performance? What's the Sharpe ratio? What's the duration? What's the holding period? What's the risk? And then what's the communication strategy? And I think that this education, it's pretty important for individuals. What we've been doing has been important for individuals. It's pretty important for family offices, especially forward-thinking ones. For private companies, maybe they could do something. But if you ask, who are the most conservative movers in the universe? Well, the second most conservative would be operating companies that are publicly traded, right? That are disclosing everything they do every quarter and regulated. And the most conservative are the banks, public companies that are actually regulated custodians of other people's assets. So the fact that we've worked our way from individuals to high net worth individuals to private companies up to, the tech innovators, and now we're working on the mega public corps and the banks, right? That's a sign of the asset improving, and education matters. Setting an example matters, right? But there's just a lot of moving parts here, and we're talking about the birth of an asset class and a paradigm shift. And in both cases, right, it's like an organic viral process, it's like, which is, they say, one of the first things they taught me at MIT about this was, they said, if you have a pond and there's algae in the pond and the algae is doubling every day, And in 30 days, it covers the entire pond. On what day of the month will you notice you even have any algae?
Investors can participate in the growth of the Bitcoin ecosystem by investing in companies that are building infrastructure, developing applications, and providing services related to Bitcoin. The Bitcoin ecosystem has the potential to create significant long-term value for investors who are willing to embrace this emerging technology. In conclusion, Michael Saylor's message is clear. Bitcoin is a transformative asset with the potential to revolutionize the financial system. Institutional investors who recognize this potential and allocate capital to Bitcoin are likely to be rewarded with significant long-term returns. As Bitcoin continues to gain adoption and mature as an asset class, it is poised to become an increasingly important component of well-diversified investment portfolios.